Hey, quick question. You have $1,000. You want it to grow. Someone tells you, just put it in a fund. Cool. Which one? There are 4. And nobody ever explains what makes them different, or why it actually matters. Because here's the uncomfortable truth. Most people invest their money without understanding where it actually goes. And that one mistake, it costs them tens of thousands of dollars over a lifetime. By the end of this video, you'll know exactly what an index fund, a mutual fund, a hedge fund, and an ETF are, what they cost, who they're for, and which one Warren Buffett himself says beats almost everything else. Let's go. Before we break them apart, let's get one thing straight. What even is a fund? Think of it like a big shared pizza order. You and 100 other people each throw in $10. Now you've got $1,000 to spend. Instead of each person buying one tiny slice, you pool together and buy the whole thing. Everyone gets a share. That's a fund. A pool of money from many investors used to buy a bunch of different assets, usually stocks. The goal? Grow that money over time. Simple. Now, let's meet the 4 types. Section 1. Index funds. The lazy genius. Here's the big idea behind index funds. Nobody's in charge. Wait, what? Yep. An index fund doesn't have some overpaid suit in a corner office deciding which stocks to buy. Instead, it just copies a market index. The most famous one? The S&P 500. That's the 500 biggest publicly traded companies in America. Apple, Microsoft, Amazon, all of them. The index fund says, we'll just buy all 500 of them in the same proportion they already exist in the market. That's it. No guessing, no picking winners, just mirror the market. And because nobody's making active decisions, the fees are insanely low. We're talking 0.03% per year in some cases. But that in numbers. You invest $10,000. Your annual fee? $3. Not 3%. 3 actual dollars. Compare that to what's coming later in this video, and your jaw will drop. Now here's the kicker. The S&P 500 has delivered an average annual return of about 10.33% since 1957. That's not a typo. 10% per year, on average, for almost 70 years. Your next question might be, okay, but if it's so good, why does anyone use anything else? Great question. Let's find out. Section 2, Mutual Funds. The guy who thinks he's smarter than the market. A mutual fund is also a pool of money for many investors. Same concept, but here's the difference. There's a fund manager, a real human, a professional. Someone who studied finance for years, sits in front of 6 screens, reads hundreds of reports, and decides which stocks to buy and sell. The idea is, maybe a smart person can beat the market. Pick the winners early, avoid the losers, earn more than just the average. Sounds good. Now here's the problem. Active fund managers charge for that expertise. Typical expense ratios for actively managed mutual funds run between 0.5% and 1.5% per year. Some go even higher. Let's do the math. Say you invest $100,000, a 1% annual fee. That's $1,000 a year. Gone. Every year. Even in years the fund loses money. And remember, fees compound too, just like returns do. Over 30 years, that 1% fee difference can eat up literally hundreds of thousands of dollars from your final balance. Here's the uncomfortable part. Most active fund managers don't actually beat the market long term. Study after study shows this. So you're paying more for worse results. Does that mean mutual funds are useless? Not entirely. Some work well for specific strategies or niche markets, but for the average person, the data isn't kind. Now let's talk about the Wild West of investing. Section 3. Hedge funds. The VIP room nobody told you about. Hedge funds are not for you. That's not mean. That's literally the law. In the U.S., you need to be what's called an accredited investor to get in. That means either $1 million in net worth, not counting your house, or an income of at least $200,000 per year. Minimum investment, often $1 million or more. These are pools of money for the ultra-rich, run by extremely aggressive fund managers who use strategies that normal funds can't touch. Short selling, leverage, derivatives, complex bets on currencies, commodities, interest rates, you name it. The pitch is, we can make money in any market, up, down, sideways. And the fees, buckle up. The standard is called 2 and 20. That means 2% of your total assets every year as a management fee, plus 20% of any profits the fund makes. The average management fee across hedge funds is around 1.5%, and the average incentive fee is around 19%. So they take a cut when you win. They still take a cut when you lose. Result? From 2008 to 2017, hedge funds returned an average of just 3.8% per year after fees. The S&P 500 returned over 7% in the same period. One analysis of hedge fund data from 1969 to 2024 found that gross returns were about 8.3%, but after fees, net gains dropped to around 4%. Meanwhile, basic treasury bills, basically government savings bonds, averaged around 6% risk-free over the same period. Translation: the average hedge fund, after fees, didn't even beat the safest investment on earth. Hedge funds aren't a scam. Some are genuinely exceptional. But as a category, the math is brutal. Now let's talk about the one that's basically an index fund, but cooler. Section 4. ETFs. The index fund that trades like a stock. ETF stands for Exchange Traded Fund. Here's the one-sentence version. It's basically an index fund, but you can buy and sell it anytime the stock market is open, just like a regular stock. With a traditional index fund, you buy in at the end of the trading day, at whatever price the fund closes at. With an ETF, you can buy at 9:30 a.m. and sell at 3:45 p.m. if you want. Real-time pricing, full flexibility. Fees? Extremely low. Usually between 0.03% and 0.20% per year. The most famous ETF in the world, SPY. It tracks the S&P 500. Nearly $600 billion in assets, traded millions of times every single day. ETFs also tend to be more tax efficient than mutual funds because of how they're structured. They trigger fewer taxable events inside the fund. Who's it for? Anyone. You can buy one share of SPY for the price of one share. No minimums like hedge funds. No waiting until end of day like mutual funds. Your next question might be, so what's the difference between an ETF and an index fund, really? Honestly, for most people, almost nothing. Both track an index. Both have low fees. The ETF just gives you more flexibility in how you trade it. Section 5. The number that should make you think. Let's put all four side by side. One simple lens. Fees. Index fund. As low as 0.03% per year. ETF. Typically 0.03% to 0.20% per year. Mutual fund. Typically 0.5% to 1.5% per year. Hedge fund. 1.5% management fee plus 19% of profits. Now imagine investing $10,000 over 30 years with a 10% annual return. At 0.03% fees, you end up with roughly $173,000. At 1.5% fees, you end up with roughly $117,000. Same market, same return, different fee. $56,000 difference. Gone. Not to your future self, to the fund manager. That's not a small number. That's a car. That's a year of someone's salary. That's money that should be yours. So what does Warren Buffett actually recommend? Index funds. Specifically, low-cost S&P 500 index funds. He said it publicly, repeatedly, for decades. He even won a famous $1 million bet in 2008 that a simple S&P 500 index fund would outperform a group of hand-picked hedge funds over 10 years. He was right. 3 things to remember from this video. 1. A fund is just a pool of money invested in many assets at once. 2. The lower the fee, the more of your own money you actually keep. 3. Most active strategies don't beat just copying the market. The data says so over and over again.